Welcome to Breaking News 2 Trading Moves, and welcome to the debate. When you picture the ultimate risk to a financial portfolio, well, the image that usually comes to mind is external.
Right, like a sudden market crash or something.
Exactly. You might picture a crash, an unexpected central bank policy change, or, an algorithmic flash crash wiping out value in milliseconds. We spend our days staring at monitors, looking for the threat out there in the data.
We certainly want the danger to be something we can model or chart. I mean, if the threat is on a spreadsheet or a price graph, we feel a sense of control over it. We can build a defense against it.
But if you step into the behavioral psychology of trading, that threat model turns entirely inward. We are looking at a landscape where the primary danger isn't the market at all. It is the mirror.
Oh, for sure.
Today, we are looking at where the real danger to your portfolio lies. Are you your own worst enemy, or is it the guy you're paying a 2% management fee to? I will make the case that your own overconfidence and the painful psychological mechanism known as cognitive dissonance are what actually tank your portfolio's value.
And I will argue that handing your money over to professional fund managers does not solve that bias. It merely redirects your ego preservation mechanism, exposing your portfolio to manager narcissism and high-cost, distorted blame mechanisms.
Let's lay out the foundation on the individual side first. The core issue destroying portfolio value is the human necessity to avoid cognitive dissonance.
Drawing on Festinger's theory there.
Exactly, yeah. That is the psychological term for the awful, tense feeling you get when the facts in front of you contradict the story you tell about yourself. In trading, this happens daily. You buy an asset believing it will go up. The market price drops.
Which is undeniable mathematical evidence of a loss.
Right, but you now hold a belief about your own competence right alongside that math. The brain hates that gap, and, well, it will do almost anything to close it. To reduce that discomfort, your ego engages in motivated reasoning.
You look for any excuse to justify the bad trade.
Yes, and this directly causes what behavioral economists call the disposition effect. It's a very well-documented phenomenon where investors hold onto their losing stocks and sell their winning ones. If you're listening to this and you've got a stock in your brokerage app right now that is down 40%, ask yourself, why haven't you sold it?
Because the ego refuses to click the button.
Precisely. The math says cut your losses, but realizing a loss forces you to admit a mistake, causing actual psychological pain. Selling a winner, on the other hand, provides a quick hit of validation. It proves you were right all along.
Even if holding that loser damages your long-term returns.
Yeah, exactly. And we also suffer from the illusion of explanatory depth. Cognitive scientists have shown that people systematically overestimate their understanding of complex systems. Ask someone to explain how a zipper works. They think they know.
But then you ask them to sketch it out.
Right. When you hand them a piece of paper and ask them to sketch out exactly how the slider interlocks the teeth, they stall out. They realize they have no idea. Apply that to the stock market. You buy a complex tech stock or an ETF, assuming you understand the underlying mechanics. When it drops, you ignore concrete market data in favor of protecting your self-image, doubling down on bad positions simply because your ego cannot tolerate the admission of error.
Your diagnosis of the retail trader is very accurate. But I look at the proposed solution, delegation, and I see a far more dangerous dynamic. You might think hiring a professional removes your ego from the equation, but the data proves otherwise.
You see it as introducing a new problem?
A massive one. When we look at Ninjo's research on fund managers, particularly the extensive analysis on how specific personality traits affect returns, we see that manager narcissism measurably reduces fund performance. We are taking the retail investor's everyday bias and replacing it with unchecked institutional overconfidence.
So you view that narcissism as a structural flaw in the delegated model.
A fatal one, especially because it comes with high financial costs. The empirical analysis shows that highly narcissistic managers make riskier decisions. They genuinely believe they can outsmart the market. Because of this, they exhibit remarkably high trading frequencies.
Churning the portfolio?
Exactly, buying and selling week after week.
And that generates immense transaction costs. Those fees and bid-ask spreads silently but aggressively erode long-term returns. And here is the real trap for the retail investor. Delegating does not cure your own bias. We see this in the reverse disposition effect in mutual funds. Investors aggressively sell losing funds while holding on to the winning ones.
Wait, so they do the exact opposite of what they do with individual stocks?
Yes, and that proves delegation is merely a mechanism allowing investors to use the manager as a scapegoat. You fire the manager to alleviate your own dissonance without ever addressing the root psychological flaw. You get to say, I didn't make a bad investment. The manager I hired is just an idiot.
I see your point, but if we look at the underlying math of a bad trade, why do retail investors actually freeze up when acting alone? What is happening in their brain right before they hit the sell button? Let's connect the dots here with an incredibly revealing experiment known as the story treatment.
Oh, right, the justification experiment?
Yes, researchers tested what happens when investors are explicitly reminded of their original reasons for purchasing an asset. Imagine a trading interface that makes you type out a sentence about why you are buying a stock before the order executes.
That forces the investor to go on the record with their logic.
Precisely. Then, when the stock's price drops, the interface prominently displays that exact justification you wrote down. When confronted with their own written logic, the ego actually intensifies. The ego actively rejects the mathematical reality of the loss because it directly contradicts their documented reasoning.
It's an evolutionary adaptation to tell a cohesive story about our competence.
Exactly. We need our past actions to make sense with our current self-image. When the market provides data that breaks that story, the individual investor will hold on to a plummeting asset, sometimes all the way to zero, simply to avoid closing the loop on that cognitive dissonance.
I understand the severity of the individual dynamic, I do, but let's look at the parallel experiment from the material, the fire treatment. In this setup, researchers modified the concept of selling a fund. They changed the wording on the interface to firing the manager.
Oh, wow. And what happened?
When investors can blame an intermediary, they sell losers aggressively. They purge the losing asset from their portfolio without hesitation.
But they are doing it for emotional relief, not for rational portfolio management.
That is my point exactly. They do it because it serves as an emotional shield. This proves that delegation is utilized primarily to protect the ego, rather than as a strategic financial tool. Instead of rational capital allocation, the investor engages in reactive revenge trading.
Just to punish someone else.
Right. They are not looking at the underlying asset's core value or the long-term strategy of the fund. They are punishing the manager to cleanse their own psychological palate. The intermediary becomes a sacrificial lamb for the investor's cognitive dissonance. You pay a fee just to have someone to blame.
Reaction, masquerading as logic. It reminds me of this bizarre study by Mercier and Sperber looking at moral judgments. They had participants evaluate various moral dilemmas, but they sprayed a foul odor, essentially fart spray, in the room before the participants gave their answers.
Fart spray? Seriously?
Seriously. And the severity of the participants' moral judgments correlated directly with the intensity of the unpleasant odor. People ended up making harsher moral judgments just because they were physically disgusted. But when asked, they falsely claimed they were performing perfectly rational analysis.
I see where you're going with this.
Yeah, I'll argue that the ability to fire a manager is just financial fart spray. You feel psychological disgust at losing money, so you trigger an unconscious, severe emotional judgment firing the manager to relieve that disgust, all while pretending you're making a calculated financial move.
That is a revealing analogy. And you are right that the retail investor is treating the manager like a release valve for their own disgust. But let's look at the other side of that transaction. Put yourself in the psychological state of the professional managers themselves. This is where the real structural danger lies.
You mean the managers acting on their own egos?
Yes. When you delegate, you do not remove ego from the equation. You just hand your capital over to a professional who is rewarded for having an oversized ego. We're talking about the research isolating narcissism as a measurable trait in those managing large funds.
The Chinese fund manager study, right?
Exactly. Studies tracking the behavior of managers handling billions of dollars. These professionals are operating under immense pressure, dealing with uncertain outcomes every minute of the day. Their need for validation, their absolute necessity to be perceived as the smartest person in the room, well, it dictates their trading strategy.
Leading to the high turnover you mentioned.
Right. It creates portfolios with massive turnover. They trade frequently to assert control, to prove their market thesis is correct to their peers and to themselves. The structure of delegated asset management actually subsidizes and amplifies this narcissism. Your capital is exposed to a manager whose primary drive is ego gratification, dressed up as a search for high returns.
Okay, I'll push back on that interpretation of professional environments. Professional trading floors are expressly designed to channel these exact traits productively. Let's look at the University of Portsmouth team production experiments.
The ones exploring how individuals allocate effort based on ego?
Yes. Researchers framed tasks as intelligence tests and utilized a best shot production mechanism. Think of a best shot mechanism like a relay race, where only the fastest runner's time counts for the whole team. The team's total output depends entirely on the maximum individual performance.
Which is a very accurate representation of the superstar culture in high-stakes finance. One-star trader often carries the year's performance for the entire firm.
Exactly. Many professional fund environments operate on this exact best shot basis. The fund's success relies on a few massive wins by a highly confident manager. The researchers found that in these ego-relevant best shot scenarios, individuals become highly responsive to their teammates' expected contributions.
Meaning they try harder if the ego stakes are high?
Yes, they allocate their efforts strategically based on the environment. This suggests the high-pressure, ego-driven fund environment might actually harness that narcissism to produce optimal intended effort. The structure forces the ego to align with maximizing output rather than just blind overconfidence.
Well, I think you're interpreting that data far too generously regarding optimal output. Let me highlight a crucial detail from that exact same team production study. The researchers gave participants the option to pay money to have actual cash deducted from their total earnings simply to see their own scores at the end of the test.
Which is a pure test of ego motivation. They forfeit returns just to look in the mirror.
They absolutely do. And the participants paid to see their own scores far more frequently in the ego-relevant conditions. What does that tell us about the fund manager? The primary driver for these individuals is self-esteem validation, not optimal team output or rational capital allocation.
They are paying for validation.
Yes, they are willing to pay a tangible cost just to feed their ego. In the real world of finance, that cost is paid by the investor through high transaction fees, bid-ask spreads, and risky, overconfident bets. The manager is using the client's capital to buy a mirror.
That is a compelling counterpoint. If both sides are trapped by ego, though, the core question becomes, does either group possess the capacity to learn from market feedback? The market is the ultimate arbiter. Does it eventually force the retail trader or the narcissistic professional to correct their behavior, or does the ego entirely prevent adaptation?
The data suggests the ego puts up a formidable block against any real learning.
It is a brick wall. We can look at the backfire effect in psychology from Nyhan and Reifler. When individuals are presented with information that contradicts their worldview, they don't just reject it, they double down. Their original belief becomes further entrenched.
Which plays out constantly in trading.
Oh, entirely. Psychologists note that when the market provides a game, the trader asks, "Can I believe this?" Of course they can. It validates their genius. But when presented with a heavy financial loss, the question changes to, "Must I believe this?"
Searching for a way out.
Right. The ego searches frantically for any excuse to invalidate the loss. They look for a fringe blog post or a conspiracy theory about market manipulation to explain why the market is wrong and they are right. The market provides relentless, objective feedback, but the individual trader's cognitive dissonance prevents them from ever updating their beliefs.
Let me add concrete data from the mutual fund experiment to show that delegation suffers the exact same fate. In the exit surveys for that experiment, researchers measured self-reported learning. The traders in the story treatment, the ones who were forced to confront their own written reasoning, reported learning measurably less when they experienced a loss compared to when they experienced a profit.
An asymmetrical learning curve dictated entirely by the ego. You only learn when you win.
Precisely. When the self-image is threatened by a loss, the learning mechanism simply shuts down. Both retail traders and narcissistic managers suffer from this identical inability to update beliefs objectively. The professional manager blames market volatility, an unpredictable central bank, or a black swan event. The retail trader blames the manager or algorithmic manipulation.
The learning block is universal.
Yes. Therefore, transferring your capital to a narcissistic manager does not solve the learning problem. It merely obscures your lack of learning behind a management fee.
Well, this brings us to a synthesis of our positions. From my perspective, the evidence remains clear that individual cognitive dissonance is the foundational barrier to sound trading moves. The inability to sit with the physical and psychological discomfort of being wrong drives the disposition effect. It forces investors into motivated reasoning, causing them to hold losers and reject concrete data.
I agree that the personal bias is severe.
Right, and unless the individual investor masters their own need for consistency and ego preservation, their portfolio will persistently suffer, regardless of what assets they hold.
And my summary is that delegation is a complication, not a cure. Transferring the responsibility to professional fund managers merely introduces new psychological risks. You exchange the retail investor's dissonance for the institutional manager's unchecked narcissism. This creates high turnover portfolios, erodes returns through transaction costs, and allows the investor to use the manager as an emotional shield, avoiding true responsibility for their capital.
We converge on the reality that psychology, not just mathematics, dictates market execution. Both individual dissonance and institutional narcissism represent severe risks. The next step for anyone managing capital is to explore how to reconstruct their choice architecture, the way they set up their trading rules and environments, to bypass these specific ego traps.
Because the human brain is not naturally wired for modern financial markets. It is wired to protect its social standing and its self-image.
Which brings us back to our opening thought. When you look at the risks threatening your capital, the most dangerous variable isn't moving across a chart on your monitor. The real threat is staring back at you in the mirror.